I was sitting down to watch the TV the other day, and I started to surf around Netflix, right? And I started watching this show called Travelers, which is kind of a binge-worthy show. Now, I don't really watch a lot of TV, but lately I've been kind of just surfing around and finding some things at night because I'm having a little trouble sleeping, frankly. And I found the show called Travelers, which is about time traveling. But the point is, Netflix is changing the way and has changed the way we watch TV. And I started to think about Netflix, and I'm like, who is Netflix's competitor? And I can't really think of Netflix having a competitor. Like, can you? Like, to me, yeah, there's Amazon Prime. So if you're a member of Amazon Prime, then you can get movies and all those kinds of things. Yeah, there's Disney Plus if you got kids. Yeah, there's Paramount and Hulu and Roku and all these other things. But when you come to the leader of the market, and I always like to invest in the leaders in the market, then I don't think there's anybody that holds a candle to Netflix. Now, they've invested a huge amount of money in content, right? Creating these shows, House of Cards, Game of Thrones, Dexter, Breaking Bad, all these other ones. And, you know, I guess they're pretty good. And people watch them and talk about them all the time. So I want to talk about a few stocks that are breaking out. And I want to talk about retirement, because if you can start to catch some of these trends that are in these stocks, you can set yourself up for income in retirement, and income right now towards retirement, or after retirement, you can start getting income from retirement. So I want to go over a few stocks and what I'm looking at right now. Right now, the market's green. So when the market's green, I like to sell at the money or a little bit out of the money. That's my trading plan, but other people have different trading plans. Sometimes you can sell deep in the money and make a decent amount of money and have cushion if it goes down. But if you're out of the money a little bit, I'll show you in a second how that really adds up. So let's start with Netflix. So you can look at Netflix here. Now, the interesting thing about Netflix's chart is you've got this high back in 2021, right in here. And that's at right around like $700 or something like that. Let's see what it actually is. It's $701. Okay, and you can see that it went down. So it was really tough to be sitting through this. Hopefully, if you own Netflix anywhere around in here, you were able to sell it off, because you would have had to wait a couple, 3 years for it to come back. But now it's at a new top. Now, I talk about Netflix all year long in 2024, and I talk about how, it's been making these bases. So you can see it's at a little base here where it broke out. It's at another base here where it broke out. There is another cup and handle base right here with a high handle, and then it broke out. Look at this beautiful candle right here that we're on, this earnings candle. So, and now it's coming into this all-time high base right there. There's a base, and it's actually in a breakout right now. And so I like stocks that are breaking out. Now, I have programs where I teach you how to find stocks that break out and what the characteristics are, and then how to manage your portfolio and pyramid in and pyramid out and stop loss and all that stuff. And I also have ways to make cash flow called the cash flow machine. So I have two different methodologies that I teach. And you can decide whatever one you want. But in this case, we're looking at like a 7-week cup pattern. And so we had a little cup pattern, and here it is at the top. And now it's a little bit into a breakout right now, right around the $700 level, $695 it is. So that is a good spot. Let's take a look at the options here on this chart. So here we have the options, and I like to go out a week, maybe two. My program, we shoot for making 1% to 2% a week, and that does incredibly well if you hang in there. Now, we're looking at Netflix at $695.72. The market just closed, so it's not moving around, so I can do an analysis. And what we're going for here is this column called time value. It's also called extrinsic value in some people's systems. And so this time value is what we're looking at, okay? And so what I'm doing is, if the stock is $695, I want to sell slightly out of the money. So I'm going to get just one strike up. Now, what I'm trying to do is pick up this $10.10, right? That's my goal, is to pick up the $10.10. I also get to pick up, if the stock goes above $695 to $700, I get to pick up the difference there. And so what it'll tell you is, if you look at where it says maximum upside, it says $14.38 is my maximum upside. Basically means I buy the stock, I sell the option here for $10.10, and I pocket the $10.10, and I have a maximum upside of that $4.38 that it could run up. That's a 2% return in 9 days. And so what we're looking at, if you look at that annualized column, if it does happen to go above the strike price, $700, we end up making 83% annualized per year. Now, you have that choice. right? You can sell that option out of the money and you can make some good upside. What if you wanted to go way out of the money? Now, I don't like going way out of the money because it doesn't give you as much cushion. But some people really believe that on a stock like Netflix that's breaking out, you can, get the breakout, plus you can get a little bit of juice while you wait. So if, let's say you want to go out to the 720s, the 720s will pay you $3.45 in juice, right? The time premium, but you can make a lot of upside if it goes up, $25 from $6.95 to $7.20. So that's what a lot of people do is they look at that option and say, well, if I can make that, I make $27.73. The issue is the probability of it going to 720 is a lot less than it's going to 700. It's only got to go up $5 in 9 days to get to 700, but it's got to go up $25 to get to 720. So the question for you is, would you rather have the bird in the hand here, 1010, more of a bird in the hand, or would you rather have the chance for it to go up, which is $3.45? If you want to choose this one, you only get $3.45 downside, protection, which means if the stock goes to 692, you're only, you start to lose money below that, versus if you do the 700s, if it goes to 690, you got plenty of, 685, you've got plenty of protection there, right? So you've got a cushion. That's the difference in cushion. So you have to decide what it is for you. Now, I have a program where we teach you in the money, at the money, out of the money strategies. The market's green right now, like I said before, and so I would probably look at doing those 700s and taking the solid $10. Now, on 1,000 shares, which is pretty expensive for this stock, that's $1,000 in 9 days. That's $1,438 in 9 days if it goes all the way up to 700. That's how that works. All right, let's go a little faster. I got 4 other stocks that are looking really solid right now in this market. Hey, and I don't know if they're going to go up, but I believe that the chances and the probabilities are in our favor. So take a look at these. Costco. Now you can look at Costco. It's a beautiful chart, long term. I just did a video on this on a YouTube channel and Rumble channel if you want to take a look at it. But it is breaking out, and I talked about that this week about how it's breaking out, and it's peaking above that breakout spot right here. So it to me looks really good. Now this is not as volatile a stock, so it's probably not going to have quite as much juice. But let's take a look at it. So here's what we're looking at, and we're going to go out to the 9-day calls, just like we did on the other one, and we're going to say, all right, the stock is at 909, so I'm probably going to sell the 910s and pick up $11.85. That'll give me, if it goes above 910, which is my strike price, that'll give me a profit of $12.59, right? So it's $12.59, which is, see how it's different? 1.38%. Still a pretty good annualized percentage. If you can get 1.38%, every 9 days, and you can keep it going and it goes above your strike price, then you can pick up an annualized, 56% return. So I like Costco here. I think it's in a breakout. If it breaks out, I believe, and I think I said this on my other video, that it's going to about 1100 or 1150, something like that, before it starts to do some consolidation. And that's a good spot where I would be taking profits unless it rockets up there. Okay, the next one is Meta. I've recently done a video on this one as well. And by the way, if you haven't subscribed to my Insider Tips, you get all of my videos in one shot once a week in a free newsletter called Insider Tips. The link is probably below somewhere. The next one is called Meta. Now that's Facebook basically. And you can see this looks like kind of that Netflix chart that we started off with, right? Big swoon down, and then we had this big up. And now we're at an all-time high, and we're looking at a breakout here where it still has a little bit of room left that wants to kind of challenge this breakout. So you can look at this maybe like a cup, and there's a little handle there. And it's a high handle, and the top of the high handle is where it's going to break out, which looks like about 545, something like that. So that's how I look at Meta. But if you want to create some income from it, cash flow, I highly recommend it. So I would look at these options. And so here we are, 9 days out on the options. Now you can go out farther if you want, but I'm looking at 9 days out. I think that's kind of the sweet spot for at least where it is today. And the stock is $519.35, so it's really close to its $520 strike price. Okay, if you can get the $975 that you get for selling the option there, that $975 right there, and it goes up above $520, which is only another 70 cents, and closes there next week. That's your maximum profit. Your maximum profit is $10.40. Okay, so $10.40, that gives you about 2% for the 9-day period. Let's call it the week, 2% for the week, which annualized is 81% a year. Now that means it keeps going above your strike price every time you do it. But that's what we teach you how to do. And by the way, I just had somebody that I talked to on a call, and they said, well, why are you selling why are you selling in the money? So sometimes I sell in the money. And that depends on if the stock is not ready to go and it's not breaking out, or if the market is red or is yellow maybe. And there's reasons that I sell in the money versus at the money. There's also ways to get into a stock and get out of a stock so that you can have your best probability of making the money on it. So we teach you all that stuff in the program as well. But that was a good question. It's just that no market's the same ever twice in a row, but we try to get probabilities on our side. Okay, the next one is Apple, and we all know Apple, right? Apple is just got a beautiful chart, nicely chugging on the way from the left to the right. That's what we like to see, is that beautiful chug. And we had a correction back under 200, a few weeks back when everything corrected, it seemed like. And now it's kind of back up above its 50-day moving average, and it's coming in for that all-time high at 237. And that's where it wants to break out. Now, that to me is a little bit late stage, but let me tell you what's going on with Apple. And I'm not an Apple expert, but I know enough to be dangerous. And Apple is coming out on September 9th or September 13th with their new iPhone 16, okay? All the nice big formats, going to be a little bit bigger phone than the 15, all that kind of reasons to upgrade. But their big upgrade cycle reason for you to get an iPhone is that they have AI, ChatGPT, built into the iPhone. And so if that's built into the iPhone, and I'm trying to wonder, if it's built into that iPhone, is it going to be built into their iOS so you get it even if you have an older phone? We'll see. But they're supposed to have all kinds of bells and whistles, and they're predicting that this is going to be a very big upgrade cycle for Apple. So if Apple can get to this 237, I see it going to 250 pretty easily, especially if it breaks out coming into that release of that phone on pretty decent volume. The market's green right now, so the odds are kind of in your favor. But let's see if you want to create a little cash flow while you wait. On this stock. And Apple is one of these great stocks that a lot of people in my mastermind group here are collecting lots of cash. I got one guy in the group he's up about 37% this year, and he mostly does Apple. It's like 58% of his portfolio, and he just buys Apple, sells calls against it, and he's doing extremely well. It doesn't hurt that the stock is generally up, but he's also collecting that income. So let's talk about collecting the income. So we're going to go the 9-day strike just like the other ones. So we compare apples to apples. And you can see Apple is 228 and we're going to do the 230s, okay? So just a little bit out of the money, a couple bucks, but if it goes out of the money, we're going to get 245 of it, right? No matter what happens. But if it goes up above the strike, what I meant to say there is we're going to end up making $4.27. Now that's 1.87% for 9 days. Doesn't sound like a lot, but when you annualize that, I'll take it. It's 75.89%. I like 75% a year. Now, I'm not saying you're going to get that. I'm saying if you can annualize this trade and it keeps going up and above your strike price and you can do it every 9 days, that's what you're going to get. And so Apple's not that expensive. For $228,000, you can end up making $4,270 a week or every 9 days in Apple. Okay, the last one I'll talk about is a little bit different pattern. So you can see this is Shake Shack, and we had a big correction there, and we've had a beautiful recovery, over the last year and a half, 2 years, something like that, okay? And so that's been a nice recovery. Now, it hasn't gone up to its all-time high, which is what I think the target is on this stock. That all-time high is right around, 100 and let's find out exactly, 138.38. And so the stock right now is at 107.42 with a triple top going on right here, exactly or just a little bit above where it is right now. So that triple top's at about 110 and the stock is at 107. So let's look and see what we would get on covered calls if we were to be able to sell the calls on this. So looking at the calls, we're not going to look at the 2 days, we're going to go out 9 days and we're going to say, all right, the 109s, because the stock is at 108.20, the 109s are going to give us $1.65. Okay, so we're going to pick up that $1.65 right there, and if it does go up above the 109 strike price, and that's 80 cents, that's less than 0.8%, right? It's probably about 0.7%. But if it gets above that 109 level, we're going to make the full $2.45, which is 2.26% annualized. Sorry, 91% annualized, or 2.26% for the 9-day period, right? Now, I'll tell you why this is cool, because this is a $107 stock. And so for $107,000, you end up making $2,450 a week if this thing goes to its maximum upside. And like I said, it's the right stock in the right market at the right spot on the chart. And the 5 that I've shown you right now are pretty close to the right spot on the chart. And we're in a green market, right? So we've got a lot of good probability things giving us a tailwind, and that's what we like. So taking a look at those stocks, there's an opportunity for you to make some money. And this is the way that a lot of people are setting up their retirements now. They're buying the stock and they're selling the call. Yes, you can go out of the money, and the more out of the money you go, the less you make on the juice, but the more you make if the stock goes up. And if you sell at the money, you can see you're getting the highest amount of juice. Like this 108.20, you're going to get 205.65 or 205. And so if you get 205, that's the highest amount of money that you can make, right? If you go out of the money, you make $1.65, and if you go more in the money, well, at 212 is pretty good, I guess, too. So you end up making 212 there. So that's, right in here, 207, 208 is where you make the most amount of money. And if you go deeper in the money, you give yourself all kinds of protection, but you give up some juice. So there's all different kinds of ways to slice this. And now let me show you real quick what happens if you can just pick up 1.5% a week. And I just showed you 5 stocks, and I showed you the weekly or the 9-day period of time that you can pick up. Most of them are 1.5%, 2%, maybe a little bit more. If we could just get 1.5% a week, I'll show you how that math shakes out. By the way, at 1.5% a week, that's about 6% a month. We're not going to shoot for 6. We're going to say, some weeks we're not going to get 1.5%. We're just going to try to collect that 1.5% on an average, right? So let's just say on average we get 1.5%. Let's round it down and say we're only going to get 1%, which is basically 4% in a month. You with me? So now we're getting 4% in a month, okay? And if we could just do this over and over again, and I know the stock has to go up, and I know the market has to be right. I can't predict all those things. I just have to tell you what happens if you do this strategy consistently over the years, okay? So what we're going to do is we're going to go to investor.gov, okay? Go to investor.gov, and you're going to go to the financial tools and calculators, and it's going to come up with the compound interest calculator. So click on that compound interest calculator, and that'll bring you to this screen. And that's really simple. Now, let's say you have $200,000 to start. Maybe more, maybe less. Doesn't matter what it is. You put your initial investment. Now, we're not going to be adding anything to this other than what's generated inside the account. And the idea is we're not going to pull out the money now, right? We could if we have a big enough portfolio, but we're not going to pull up the money now. We're just going to leave the money in there to compound, just so you can see what it's like. Let's say that you're 50 years old and you're going to let this run for 15 years till you're 65. Perfect. And then you put in 15 years. And then you say, well, 4% a month. Remember, we're discounting it from 6 down to 4 just for, some flub factor, right? We're discounting it quite a bit to 48% a year, which 48 divided by 12 is 4% a month. And so you say, okay, I'm going to try to get 48% a year on average. Some years you might get more, and some years you might get less. But let's just say we can get 48. And I know it sounds to a lot of people like it's crazy. So we've got 48% in there. You can put whatever number you want, but 48 goes along with my example. Okay, and we're going to compound this monthly, right? It's 4% a month. And then we just hit the calculate button. And after 15 years, you can see the number. 15 years, you will have $232 million. Okay, sounds preposterous, doesn't it? Well, the numbers don't lie. The numbers are really, if you look at the early years, you can see that the numbers don't go up that much, right? In 3 years, you got 820,000 because you're really compounding it well. But according to this graph, it doesn't move that quickly. But, look at how it ramps up. That's the beauty of compound interest. And it goes to this crazy number of $232 million after 15 years. Okay, well, gosh, I don't know. That seems pretty aggressive and pretty unrealistic to me. The numbers get stupid. So let's cut the numbers in half. Let's say you can only get, instead of getting 1% a week, you only get 0.5% a week. Okay? Well, that turns into a 24% per year number. Well, that's not bad. If you can compound it monthly, great, because we're getting this on a monthly basis. It's still $7 million. Okay? So all you have to do is do this 3-step process. You find the right stock. We find the right option to sell against it. And then we're not even counting what happens if you're out of the money and you get the appreciation. And we're also not counting on the other side what happens if the stock goes down. We're just doing an average, okay? And we think the stock is going to stay the same or go higher over the next 15 years. Now, if we do that, then the third step comes in where we can do the calculation. And now, can you live on $7 million in your retirement? Can you live on the other crazy number that we put in there, right? And so all you have to do is say, well, I'm going to pull out 10% a year, right? We're already showing you how to make 24 to 48, but you pull out 10%, you're still going to be living on 700,000 on this lower number. So I hope you can see that if you start to think a little bit more long term rather than what's going on this quarter or this week, you're just going to try to shoot for making 1.5, 2% a week. You find a good quality stock in the right market at the right spot on the chart. Of course, you have some things that you have to do. You have to correct things when the market goes down and things like that. But on average, if you just kind of leave it alone and just collect that money week over week over week for 15 years, you're going to have an incredible amount of money at the end of it. So do you see why I get so excited about this? I mean, it's cool. The numbers are ridiculous and they're amazing, right? And so you just saw it. Now, if you temper those numbers for yourself, they're still pretty darn good. But the main thing that you have to do is, if you're going to do covered calls, have a system. Just make sure you learn some kind of a system.